board of management on the show, and we have with us Mr. Ajay Bhutoria, MD and CEO of Zensar Technology. Ajay, hi, good afternoon. Thank you so much for making time. Now, FY22 saw a double-digit growth with a quarterly run rate of 4 to 5%. Can this sustain not only in the immediate term but long term as well? What's your sense?
We closed the quarter with 153.2 million, which quarter on quarter was 4.2% growth. And year on year quarter was 27.4% growth. Early in the year, we put a new strategic framework in place. And then through course of the year, we were laser focused on execution. And what we saw in the early quarters was green shoots. And as we came into this quarter, we saw continued momentum. We saw continued strengthening of our business. And as we look now into the future, we will continue to drive execution and build resilience. We believe we are in the groove right now with how we are executing.
So as far as FY23 is concerned, should we expect a double-digit growth to continue?
Right. So we build momentum across board, across our verticals, across our geographies, across our service lines. So the growth has been broad-based. If you look at what we've accomplished this quarter, coming out of this quarter, the order book has also substantially improved. So in all the business metrics are pointing to the right direction. And that's something that I can share with you at this stage. We don't give out guidance, but the business metrics are looking very positive.
Sure, Ajay, I had to try my luck there as far as the guidance goes, but your margins have slipped from 18-19% earlier to 14-15% given the investments that you have made in talent and headcount. How do you see it trending back to the 18-19% level? Should we expect it to come back in FY23 itself?
So, yes, we've seen some margin headwinds over the course of last 3 quarters. These headwinds are largely driven by increased cost of delivery, which in turn are because of 2 reasons. One is that attrition for us has been at an unprecedented high in course of the year. Although in the last quarter, we saw an improvement. The in-quarter attrition was better than what it was the previous 2 quarters. But that's something that has put pressure on cost of delivery. Also, we've been through a very inelastic talent supply chain market. And this is a global phenomena. This is an industry-wide phenomena. And this is especially exacerbated in the case of India, as I say. And that has impacted cost of delivery for us. We had to hire to fill up attrition. We had to hire to fill up what has been a very strong growth here for us. So the result of which is we are now in mid-teens. And I think we'll continue in the mid-teens. Having said that, we've put a bunch of measures in place to drive up our margins to improve our cost of delivery. Namely, we've significantly cranked up our organic engine, our whole freshers program. We are doubling down on right-shoring. We are looking to expand our talent catchment area by expanding into our delivery centers out of our core, sites, which are Bangalore, Pune, Hyderabad. We set up the Calcutta operations. Outside of India, we started the Colombia operation, earlier in the quarter. So overall, we are spreading ourselves to ensure that our talent catchment increases. And then, certain commercial discussions with our clients. So overall, in the immediate term, we'll hover around where we are right now. But our objective is that in medium to long term, get to our target of high teens.
So the cost of delivery has gone up. How do you see that happening? But how would you manage to pass on the excess cost to your clients?
So, I'll answer the question in 2 parts. The first part is easy. There have been positive, selective commercial conversations, right? And that is something that's going to continue. That happened last year. That's going to continue this year. So selective, positive commercial conversations. In terms of the overall environment that our clients operate in, the impact of inflation, etc., right? The clients generally, if you look at the markets and our clients, came out of the pandemic pretty strong. Most of them have delivered very good business results. Most of them have had increase in their budgets. And we've also seen, them given the huge focus on evolution of their business, and making sure that, the technology keeps up with how the business evolves in this mixed and hybrid world going forward. A lot of transference also from run side of the house to train side of the house. Now, we are also watching the global economic movements. We are also watching the geopolitical movements very carefully. And they may have some short-term impact, but what we firmly believe is that the secular trajectory of growth of the tech spend is going to continue over medium to long term.
Well, yes, Ajay, you mentioned that the deal pipeline was especially robust in the quarter gone by at $165 million. Can it sustain at these levels going forward, or do you expect it to plateau at some point of time?
You're right, $165.6 million of deal wins the last quarter, which quarter on quarter grew 30%. So it's been a very healthy deal win number for us. And like I mentioned, the overall franchise for us has strengthened, right? We've been executing very strongly over the last 3 quarters, and that focus will continue. We've got laser sharp focus on building resilience and strengthening our business. In the immediate term, the demand environment remains where it was for the last several quarters, right? So in the immediate term, that is right now, as I speak with you, the demand environment is, relatively unimpacted by what we hear around the globe, around what's happening with the global economy and geopolitics, right? But that doesn't mean that things will not change in the next 2 quarters. So we are very focused on the here and now. We are very focused on making sure that our supply chain engine can drive and manage the demand that we are generating for ourselves. And then we'll continue to watch over the short-term impacts that may happen within the global economy and the impact of that on demand for us.
Right, sir. Thank you so much, sir, for taking out time for us.